Thinking about buying an electric car and wondering if it's any good for your tax bill? Well, watch on. As a business accountant, my team and I spent all day long helping business owners on their journey, and we were getting asked a lot. We've actually produced blogs, podcasts, and all the rest of it on electric cars, and I realised we hadn't done a video. So in this one, I want to talk to you about electric vehicles, particularly in limited companies, although at the end I am going to talk to you about sole traders, because there's still some cool stuff there, but I think the main excitement around tax is generally when you're a limited company owner and you're looking to purchase a new electric vehicle. So before we get into it, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So then, what's the deal? Well, I think it's worth recapping very briefly, because there is other videos we've done on this, company car basics. And that's just to say that if your company buys or leases a car and you get to use it as a, let's just say, an owner director, which is the majority of you that I'm talking to, then you're going to end up paying personal tax on that provision of that car. And the company is also going to pay best part of 14% on that benefit. And the way it works is they take the list price of the vehicle and then apply a percentage to it, and whatever that value is, you get taxed on. So you might get, for example, if it was like a 60 grand car, you might be paying combined with the company something over £6,000 in tax to have that vehicle, plus whatever it's costing you each year. And as a result, what's happened is over the years is generally people have steered away from having limited companies providing cars to the owners in a normal owner-managed director small limited company. And what they did instead is they claimed like this mileage allowance you can do. The costs of fuel and everything else has made that more of an interesting addition at the moment. But where electric cars come into it is the short of it is they've got a very low benefit in kind. So that figure I was telling you about where you're taxed on the provision of this vehicle to you is what's known as the benefit in kind rules. You might see it displayed as BIK, B-I-K, benefit in kind. And they're the ones that sting you for all the tax. Now, the benefit in kind rate on a super low emission vehicle, anything under, there's like limits. If you're looking for vehicles under 50 GKM and below, they're the best emissions that you're looking for currently at the time recording this video. And generally what happens when the government do these incentives is they tend to get progressively worse as the year goes on, but we're in a really good place at the moment with this. So your benefit in kind rate is like around 2% for an electric vehicle. That's crazy tiny. So your combined tax bill on, say, like a 60k car might be in the region of under £500 versus what we were saying about a fueled car provided by your company being well over £6,000 of combined tax. And they're just rough figures, honestly. There's millions of different reasons why they could be higher. They're not likely to be lower, but they are rough, depends on your exact circumstances. But just to show that comparison, it is a really big deal. So from having the car through the company thing's good. So if you imagine the benefit of the company providing the car to you is not only is it a small personal tax bill to do it, but you're getting tax relief on all the running costs. So the insurance, everything else. There's no actual benefit in kind at the moment on the cost of kind of charging it, so that's all fine as well. So you've not got any fuel costs because it's electric anyway, so you might have your home electric, but that's it. And that money isn't having to be drawn from the company personally and paid a tax bill on. So if you imagine if you were paying for your car personally, the company's paid tax, then you've probably extracted it as dividend or salary, both of which you're likely to be paying tax on before you can finally pay for the insurance, say. With the company doing it, not only is it getting tax relief, it's not touching your income, so it's not having any of these kind of secondary taxes. So it's a really, really good thing. On top of that, if you go out and buy it, so if you're going to go buy a new electric vehicle, you can have up to 100% of the costs knocked off of your profits in the year you buy it. So if you buy a 60k Tesla, then your profits are going to be reduced potentially by up to 60k a year. Now that might wipe out all your profit and wipe out your potential tax bill. Now, we've done other videos on what tax deductible means. So just to be clear, if you spend 60 grand on your Tesla, you're not wiping out 60 grand of tax. You're wiping out 60 grand of profit before it's taxed. So there is a difference with that. And check out the other content we've done to understand that in a bit more with worked examples. But it is really, really good still. What people often say is, oh, sweet, I'm just going to go buy a Tesla this year, then I'll flog it next year. Just to say that doesn't work, because what happens is effectively whatever you sell it for, you end up paying tax back on anyway. So you end up, actually logically it makes sense, you end up basically at a point where you've just paid tax or got tax relief on the difference. So if you sold it at a loss, you bought it for 60, sold it for 50, you'll effectively get tax relief on £10,000, so it makes sense. So yeah, I wouldn't go thinking it's some scheme where you can just sell it the next year. It really doesn't have much of a use. But if you needed the Tesla, you needed a new vehicle, then it's definitely worth looking at electric from a pure tax point of view. It's up to you to decide whether practically that makes sense and whether that's a good use of the company's funds, but it is attractive as an overall tax position right now as we're recording this video. Now, we've talked about new cars and limited companies, but if you didn't buy a new electric, but you still bought a vehicle that was under this 50 GKM level in terms of emissions, then there's still some relatively good attractive tax relief. They call it like main rate capital allowances is the technical term. And you might get like 18% a year or whatever the rate is in the tax year, slowly over the life of the vehicle, sort of keeps giving you that each year. So there's still some good tax relief on it. But as I say, the main benefit for a lot of people is just the fact that the having it each year is costing you next to no tax to have it, and the company can pay for the cost. So that's where a lot of the tax saving is. But this extra big bubble of, buy the brand new, and I keep using Tesla, but it could be other brands are available, and that brand new Tesla in year one, then there's going to be a big tax benefit potentially of wiping out a lot of the tax bill. But as I say, only if you needed the car. Otherwise, you're just spending loads of money to save a smaller amount of tax. Now, you might ask, what about hybrids? Well, hybrids is a similar idea. You're just looking at the emissions. You're also looking at the range of the battery on a hybrid. So without going into too detail, because we'd be here all day, let's just say that hybrids aren't quite as attractive, but there are some quite good ones where the battery range is high and the emissions are low. They're more difficult to come by, but that's worth checking out. And what I'll do in the YouTube description is I'll link you to a blog on our website that goes into that in a bit more detail. Now, we've also talked about buying. What about leasing? Well, leasing is the same in terms of the actual provision of it. So the company leasing it, giving you the car, brilliant, low benefit, low tax, excellent. You just don't get that sort of double bubble of the big relief in 1 year potentially with these capital allowances as they're known, but you will get tax relief on the payments that you make every month. So you're still getting good tax relief on the actual cost of the company paying for it. It's just done slightly differently. And you may get, if you're VAT registered, you may get some of the VAT on the payments. What you won't get almost certainly is VAT on the car knocked off if you buy it. That's something to bear in mind. I think the revenue site's quite misleading on this because it gives you some sort of feel that you could recover VAT, but if you dig into it, in nearly all cases you're going to get denied that. So, but just know that it on a lease you might get some of the VAT depending on your situation. And that's the limited company position. So it's pretty good. So recap on that before I talk about sole traders. You will get the running costs be able to put through. You'll pay low amount of tax on the provision to you for the car, which is the main point, and the company's bill on it is very, very small as well in terms of the tax that it has to pay on that provision of the benefit. And if you buy a new electric, you've got that potential option of having the 100% of the cost knocked off your profits in year one, so it's pretty good. If you buy secondhand, you're still going to get, if you keep under that 50 GKM figure, you're still going to get some good reliefs. So that's kind of where we are with that. And in sole traders, this whole idea of benefit in kind, if it doesn't apply to you, that's a limited company employment taxes thing really. For you as a sole trader, what you're interested in is what's the deal with those capital allowance rules on the cost of the car? And actually they're very similar. So if you buy a new unused electric, you've got up to 100% being knocked off your profits. But what they do is they restrict that depending on how much you use it personally. So if you're, say, just broad brush, 5 day a week type person, and at the weekend you use it for personal, then you might restrict it by that proportion, the 2 day proportion, add some of the relief back. So it's still really good, you still get it, and the same kind of rules apply. And the same if you buy non-new, so you buy an under 50 GKM car, you're still going to get those capital allowances at a percentage a year, and same deal, you're going to restrict that percentage by a little bit for the amount of use you have personal. What I would say on that, to make sure that you've got the right accurate figures, is keep a good mileage log so you can justify how you've come up with that percentage. Don't just go, yeah, it's 50-50 or it's 25-75, whatever the case may be. Do keep a mileage log to prove that percentage. And that is pretty much the overall summary of where we are with electric cars. Do look into them, that might be worth it for you, but do check out your individual circumstances. If you know anybody that needs to know this info, please do share it with them, and I'll see you at the next one.